too. He has a wealth of experience. You might have seen him in one of Phillip Securities webinar, or you might have seen him in a trade event. Paul is highly experienced, and alongside with him is our moderator of the day, is none other than the CEO of Phillip Futures, is Mr. Tayu Chechen. And today, what are we speaking about? We're going to be talking about beating inflation with equities or securities, and what are the strategies or sectors that you should consider. We will get to that. Other key questions that we will be addressing in this session is none other than, has inflation arrived, or are we at stagflation? A term that's pretty much talked about in almost every other news article that you are reading right now. And how has inflation impacted the various sectors? What is the strategy that you should consider if you're a stocks trader? And of course, our favorite, what are your favorite stocks, long-term and short-term, that we should look at or consider in the coming months? We will be fielding that to Chechen and Paul Chu, and they will give us their honest insights. And Chechen, if you're all set to go, I will hand the reins over to you right now. Chechen, please.
Hi, good evening, everyone. Thanks, Sri, for the introduction. Paul, thanks for joining us for the session tonight. It's 8 o'clock. I hope you have taken your dinner and I just heard that you have finished your jogging for today. So
yeah,
hope you're all energetic.
Yeah, I hope I'm not perspiring on camera. Anyway.
Okay. You look radiant. So I think it's thanks for joining us. This one is inflation. When we started this series on inflation back about 4 months ago, right? There's some talk about inflation. The noise isn't as loud, but in a way, perhaps we organized this in a timely manner. Over the last few months itself, we have been hearing more about inflation. So I remember when we started, we were talking about the cost of drinking a cup of coffee in Singapore, which has like increased in price from $1 to close to $2. It's like almost 100% increase over the last few years itself. And then we also shared with some of the audience about the plate of chicken rice, right? That it used to be $1.50, now it's like you could hardly find a $3.50 chicken rice. So that probably reflects my age as well. Okay, so Paul, you are certainly much younger. Later on, perhaps you can share a bit with us about like what inflation means to me for the middle-aged person. Right, it's like we really have seen the price of chicken rice increasing from like $1 plus to $3.50, $4. So that's something that I remember. So maybe Paul, you can share a bit with us. What does inflation mean to you?
Yeah, I think inflation for me, I think food isn't probably not such a significant impact. I guess at our age, it's probably going to be education and healthcare and insurance. Yeah, I think probably that is probably more critical as we kind of get older. Yeah.
Okay. Yeah. Like this morning, I think the big news this morning was that MAS tightens the Singapore dollar policy, and that's like in a way is ahead of expectations. And one of the things quoted is because of inflation. So that's why they're tightening up on the Sing dollar policy. So perhaps, Paul, your experience, can we use your experience and help us decode a bit? What does MAS mean when they say something like this? Tighten Sing dollar policy ahead of way ahead of expectations, and that's also because of inflation. Exactly what sort of signal are they trying to send across?
Yeah, and just to refresh, MAS always use this terminology, which kind of confuses a lot of people. One can just say it straightforward, but anyway, there are typically three messaging from MAS. So it's either you move the slope, so it's either up or down, and you move the band, which seldom happens. And the bigger move by MAS is typically when you gap it up. No, you during crisis time, of course, you gap it down. You want the exchange rate to be weaker, or likewise during abnormal circumstances. So just to give you that as a context, so right now it has been flat. It was flat since the crisis began, and MAS policy is always gradual appreciation. So this time round, I think from the data alone, it's of course growth is better than expected, number one, but also critically, the recent core inflation numbers is kind of hitting. It kind of exceeded their band. I think their band is about I think about 1% as a tech cap. So I think the most recent data was about 1.1. So I think it's also signs that the core inflation is starting to creep up, and that's why they are starting to move the band. And another side note, not that anyone asked me, but another side note is that typically the exchange rate will move about 1.7, 1.8% per annum once they do this appreciation of the Sing dollar. Yeah, but again, the trade weighted basket doesn't mean the US dollar will actually rise, but typically it's like a 1% to 2% kind of move in the exchange rate in general. Yeah.
So does it mean that it's time to go shopping overseas or to start going overseas for holiday?
Hopefully so. Everybody can't wait. Revenge of everything.
Yeah, because of the pandemic. Otherwise, lots of Singaporeans will be flying overseas, especially when the year-end holiday comes along, right?
But do note. I mean, if you're traveling overseas, do note that if you touch wood, if you really get stuck overseas, you have to be mindful of that. That's the key risk. If touch wood, someone goes overseas and then you get tested and you're stuck overseas for that 2 weeks, then that's the biggest risk. But anyway.
Okay. Yeah. So if that's the case, right? Still coming back to the Emil's question. So do you expect, like you mentioned about the so-called Sing dollar rates, the currency rates? So do you expect it to, like, or the interest rate? Do you expect interest rate to have some impact? The Singapore interest rate to have some impact, or do you expect the currency to have some impact? Yeah.
Yeah. We definitely think there's a lot of upward pressure on interest rates. Firstly, just to give you some color, I think when we started the year, most of the indicators were transient. Of course, I guess you're going to use the word transient since we might sort of study off. Transient was meant to be the base effect. So it was meant to be, from April, because the COVID started in March of last year. So everything was up, it's final base effect. But then when you go to April 21, May 21, you're starting to start to worry. The base effect is starting to wind up, but why are we still getting? So almost every inflation indicator you want to use, against choose liquidity, commodities, even rentals, I think is showing signs of hitting decade highs. So inflation is definitely here. Of course, transient, depending how you want to. Transient can be 5 years too. I mean, that's also can be transient. But I think for us, the inflation is definitely going to be here, and we think there's going to be a lot of upward pressure on interest rates. You just have to use a simple chart. Just use the 10-year bond yield against core inflation. Typically, there's always a real interest rate, but this time around it is far above. So we think inflation pressure is definitely going to be creeping up as we move along. Yeah.
So you are using 10-year bond yield versus the inflation.
Yeah. It was you just take a 10-year bond yield versus a core inflation chart. I mean, the last 60 years, apart from some aberrations, the core inflation will typically be above, will occasionally be above the 10-year bond yield. Very rarely, but it will always plummet down. To get investors will want that real yield, right? So it has been that case with certain aberrations. So right now, core inflation is 3-4%, but the real bond yield is about 1.5, 1.6. So there is a lot of upward pressure, and you will obviously, of course, feel it in the Singapore context. Sorry, just to go back to your question. No, because we will always move along with how the US, LIBOR, whichever Fed funds rate, whatever US rates you want to use, directionally we will follow that, so that it will be upward pressure on interest rates in Singapore.
Yeah. Do you see this as just a Singapore thing, or it's a worldwide phenomenon, whereby we are going to see inflation rising? Because I always remember just 1.5 years ago, that was the time. I always remember the day when crude oil prices dropped to -40, the headline news, right?
Yeah.
But even we are not talking about the specific contract that went into -40. We are also seeing other contract months that's traded as low as like $10, $12, that type of level, right? And people are talking about, are we entering a recession, deflation? But it's just 1.5 years after that. Now we are looking at crude oil prices at $80. So what has changed? You know, what has changed so much in the whole landscape that makes such a huge difference?
I think the fiscal stimulus was definitely the game changer here. The 3 trillion fiscal stimulus. So if you look at the US data, I mean, because we always reference to US, the personal income of the US consumer is actually all-time high. Retail spending is all-time high. So you want to use base effect, so it doesn't matter because it is just all-time high. So there's a big gap up in retail spend. So retail spend maybe 3%. Right now it's about 10+%, 2-3 times higher. Even you want to remove the base effect, you are still getting it. So the fiscal stimulus definitely kind of propped up everything. And the worry now, I mean, just to again get back to earlier question, is that commodity you've seen just escalated. So there is also that lag impact. So you worry now, yeah, oil price 80, but then there will be a lag impact before it starts. That's the bad news. I mean, so you get the lag impact before it hits your PPI, CPI, which is already at decade highs. If you look at US data for PPI, it's also at decade high. So this thing can continue for some time. The only caveat is that unless you get what you saw in lumber prices, where the prices just tail, or even iron ore, unless it totally collapsed. But right now, you have seen commodity prices also at kind of decade highs or even record numbers. I mean, depending which index you want to use. Yeah. So it's
certainly
here to stay.
The coffee that we drink every day, the prices of coffee has already hit the multi-year high. So that is that's already one key thing, and probably people are talking about coffee prices, the coffee that we drink, we can expect higher prices to come.
Even tin, come on, the tin. Who uses tin? But anyway, even tin is all-time high. As you probably know, because you're in tin, cotton, everything is all either decade highs or all-time highs.
Okay, so you expect all this, is it a combination of demand-driven as well as a supply disruption triggering all these inflated prices that we are seeing now?
Yeah, it's a combination. Because there's so many I mean, like palm oil, and everyone knows palm oil is because of supply considerations. And if you move along the chain, it's also because China experienced such a huge surge in production. If you look at imports into the US, it's also like record highs in terms of container imports. So that has also kind of flagged out across all industrial commodities. Our precious is pure liquidity, but what you've seen is a combination of demand and also the supply constraints. And even like container, you can also see it in container freight rates, because the bottleneck is not only at the ports, but along the trucking also has congestion and so forth.
Okay, so both demand and supply issues triggering all these increasing price.
And just to share a little tidbit, which we always like to share because it's a bit easier for everyone to understand. So like someone like Del Monte, we always share this with other people, but in the most recent call, Del Monte sells canned tomatoes, canned corn, canned vegetables. They said that they are experiencing like a 60 million hit on because of all the increase in packaging, transport, shipment, container, raw materials. So you can imagine their profits probably like 20 million plus a quarter, 80, and then you got a 60 million hit. So what can they do? The only thing they can do is just raise price. So they're raising prices by almost 10% across the board, and volumes are not impacted. Because it's a whole system wide, everyone also has to raise price. So just to give you some flavor, I mean, because it's a SGX listed, so we're a bit more familiar with it.
Okay. Oh, I believe our audience today certainly would like to hear more from you on all this, for the counters whether in SGX or in overseas exchanges, with all this inflation, who is going to benefit? is there any sector that's going to be benefiting from it, or are there like people who is going to be losing out? Because like we know that one of the things that when we talk to investors over the last few years, interest rate all-time low. You put money in the bank, you're hardly getting any return at all. But inflation is still a very real thing. So people keep feeling that, oh, I'm losing out because the money becomes smaller and smaller. So in this aspect, right, perhaps you can share with us your views on, who will benefit, who will lose out, and, as investors, what should they be doing?
Yeah, the losers, it's always easy to pick the loser, right? So the loser, at least in the Singapore context, utilities will be the first hit. I mean, utilities, there's no pricing power. At the same time, you're getting pressure on the materials, and in some countries like China, you can't pass it on. So across the board, utilities will be the worst hit. In general, speaking, the beneficiaries are no, the known beneficiary is obviously banks, because interest rates, as interest rates rise, most of their loans are variable, so they can price it up. Number one, and most of these banks, especially our DBS, these guys got like 50 billion float just lying around under their pillow. Of course, I mean, not under the pillow, but you know what I mean. It's just excess money float just lying around somewhere. So all these will just get a yeah, like some big pillows under their big pillow or something. So you get the kicker because your loans are variable, and you get the kicker because you got this float, which you don't have to do anything. You can just like, just chill out, and you get the incremental increase because of interest rates. And every 10 basis point, you can do the sums, what kind of impact it is. They get millions from just a 10 basis point improvement. So the banks, and then the third thing is that if you get this reflation, asset reflation, work through, and it flows through property, of course, it flows through working capital, then they can also get the uplift in loans. But of course, that the impact may not be so much, but the bigger impact will be on net interest margins. So banks and property, of course, will be the bigger, larger beneficiaries from a top-down perspective. It doesn't mean every property stock, as we all know in China, is a buy, but just from a very top-down macro perspective, they will enjoy these headwinds without doing anything. You don't have to do anything, suddenly you'll get an incremental lift in margins.
Okay,
yeah, so
but just for me to understand a bit more, the banks, okay, you mentioned the banks because they have a lot of float, a lot of savers. So because their loans are packed in according to variable interest. So if interest rate were to go up, the banks will benefit from it, right? But in terms of property, I always thought that when the moment interest rate were to rise, it will have a negative impact on the affordability issue. So isn't it a case whereby the property sectors will end up to be worse off?
Yeah, actually that's what I thought too. But of course, you're coming from a very low base, 1%. Even if you 1.5 down to 50 basis point, the impact on your monthly installment won't be that much. But I think more importantly is the replacement cost, which is very pertinent now. I think when we spoke to someone who does like HDB, I mean, don't quote me on the exact numbers. So maybe they were quoting for HDB maybe 150,000. And I'm just pulling a number just to give you the 150,000 per unit. Now, even at 300 plus thousand per unit, he will not even want to do it because the cost keeps on rising. So property in general should benefit because of the replacement costs. If you're assuming an inflationary scenario, that will help alleviate prices because everything is going to be more expensive to build. Yeah, in general, I mean, I'm not saying it will be every property class, but in general, that will be the factor behind reflating real estate.
Yeah. Paul, you talk about this topic. Property is always a very important topic in Singapore, and I believe all audiences will be keen to hear from you. We would like to look from your crystal ball. What's the outlook for the property market? And then even among the different property stocks in Singapore, is there some that you want to touch on a bit more, to introduce a bit more? And is there one or two that you felt that could be outperform the market itself?
Yeah. So for property, of course, the first thing before you even consider anything is what is the government? Is there any risk of intervention? the invisible hand coming in and they say, okay, enough, no, stop. I mean, they close the casino table, whatever. But anyway, right now, the risk of intervention isn't there, so it is still fine to be invested right now. Because typically what we look at is at least a double-digit rise in property price index before the authorities will intervene. You will ask any real estate agent, they use that because the authorities may think that assuming 10% increase over 12 months, or then over 5 years will be 50%, then that's a no, right, for the authority. So right now the increase in property price index is about 7-8%. So that's fine. So at least we have to clear that out of the way before we consider when investing. So the second thing is that inventory levels are very low. The last time I checked, it used to be 3-year inventory. It dropped until even 1.5 years of inventory, compared to the amount of sales that you have. So what we want are developers that have inventory to sell, right? Because right now it's almost like a seller's market. I mean, in a way, because the launches now can be 70-80% taken up. So the one that we like is CDL, city development. There are basically 3 reasons for it. Firstly, because they got inventory to sell. Most of the other developers really kind of sold out, and then they have to go in and bid. And when you bid, then you face another risk of the cycle. So they have inventory about 3 billion to sell. So that's number one. The second reason is because they have a lot of hospitality. So if you take the scenario where you're going to have reopen globally, then you'll get that uplift in growth, because of hospitality, hotels reopening. So they got a huge basket of that. And the third thing is a bit more nuanced, is that they have commercial assets that they want to IPO. CDL has a RNAV of $14. Now the stock is, I think, 6 something. But $14 is just paper, right? I mean, whether you can monetize. So if they can monetize some of these commercial properties, put it as a REIT, and they take all this in their books at cost. So this could be another catalyst that they can monetize, and hopefully dividend up to some shareholders. But you get that monetization. So all these are good catalysts to help the share price. So these are the 3. And do note that one of their more interesting property projects is the Fuji Xerox project, because they get I can't remember the exact number, but they get a jump in the plot ratio. So they can so their cost is exceptionally low, because it's like okay, thanks, now they'll just give you this nice plot ratio if you develop more residential into, it's a freebie, I mean, almost like a freebie, because they want to redevelop the whole CBD. So this one will be a very high margin project for them. Yeah. So these are these are the 3 main reasons we like it. Yeah.
Yes. So in fact, I'm taking down notes from what you mentioned just now for CDL. 3 billion in terms of development projects, hospitality, commercial, lots of commercial properties, RNAV of $14, and then the potential upside from the Fuji Xerox project itself. Right. But,
yeah, the commercial properties. Sorry, the commercial properties are in UK. They might read it. Yeah. Sorry to interrupt you. Yeah.
Yeah. Thanks. Since you mentioned about CDL, is there still any overhang from that news about the sincere property in China? I thought that's one of the things that has been weighing down on this particular counter over the past few years.
Yeah, for us, before the pandemic, before all this thing happened, I think the stock was trading, if I'm not mistaken, around $11. It's already down to $6. So, and they've already written off everything. I think they've already cleared, written off everything, make all the provisions. So on the one hand, you had this event, but on the other hand, I mean, don't want to sound like a one-arm economist, but on the other hand, you get this benefit because you already all this risk is really kind of being priced into the share price. That's why you're getting it at, I think it's 6 something right now, if not mistaken, or 7. That's why you're able to get at these levels at 7. Because all these things has been already kind of priced in, all the risk has been already priced into the stock, because it's already a well factored risk. And it's a valid question, is there any more side effect from this? But it's not, it's really all written off. The last time the property cycle was up in 2017, the last time the government relaxed and everything, the property prices shot up, the share CDL was trading about $14. So, yeah. So what I'm saying is that, taking into context, I mean that all this has been, the market has kind of derated them because of this event.
Okay, thank you. So any on top of this, any other property stocks that you will recommend? So far, beneficiary seems to be banks, right? You mentioned about banks, specifically you mentioned about DBS, property sector, specifically you mentioned about CDL.
Residential property, strangely, there aren't that many for large ones. A lot of them have been privatized. Sometimes they privatize, like Perunia, they privatize like 20-30% of book value. See, Capital Land just gave up. They just they just privatized their whole development business because no. So in the end, there's kind of what I call it. I'm not sure if I'm using the right word, but there's a rarity now because there's not many developers left that are listed apart from Oxley. That are left with a large market cap with a lot of volume. So if they could be the only proxy right now because Capital Land is no longer into development. Because it's called Capital Land Investment right now. There's no longer any proxy for Singapore residential property. So this is the only way to play it. Even Roxy Pacific also just decided to, because the market not going to price kind of like not pricing me at the right valuation. I'm not going to privatize. So yeah. So in a way, this is the only one left for residential property in Singapore.
Okay. Yeah. And when people talk about property stocks, right, the other segment they will talk about will be REITs. So is that a sector that investors should take a look and any good pickings from there as well?
Yeah, for REITs, we actually like Ascott Residence Trust, which is a service service apartment. And of course, most important is a service apartment because you don't want to be like a pure hotel and end up fighting with Hilton and you're gonna get knocked down, knocked off the ring. But so firstly we like it because it's a recovery from the whole hospitality in general. So everyone's gonna benefit. So what makes them unique, right? So the second thing is because a lot of the portfolio is in developed markets like Europe, US, which has already enjoying the domestic tourists much better than us here. I mean, sadly, so relative wise, they're much better than some of the local REITs, local hospitality REITs. So that's number one. Number two, they have a huge pipeline because the Ascott, the parent, has about I think 800 plus properties. Ascott REIT has probably about 80 properties. Of course, not everything's going to go in. So I think they've got like at least 20 that can be in the pipeline. So assuming things stabilize, there's a huge pipeline in the background to be injected. And the third thing is probably less known to a lot of people is that they've managed to sell a lot of their assets above book, like sometimes 70%. So let's not take the extreme, 30-40%. Some of their service residences. So we're wondering because most of these are already valued, right? So unless they use they're not using the right valuer like us in Phillip Capital. By the way, we do have valuation services if anyone's interested. But anyway, so the reason why their valuations are so much higher than what the values is because the person the buyer uses it for redevelopment purposes. So there's a lot of hidden value in a way in their portfolio because these are all in CBD centers. And right now Ascott is trading 20% below book. Yeah. And sorry, just to say that the book value can be a bit understated because they've sold a few properties which is 30-40% above book. Yeah, because these are all very well strategic assets. Yeah. So that's the REIT that we like. Then of course the malls. Then if you want, we don't cover this, but if you want a high beta mall or domestic recovery, then it should be Suntec REIT. Because Suntec REIT is the worst hit, right? So you want to take the one that's at the very bottom. So they got hit the most because there's no MICE. I think we all know there's no convention, there's no MICE card, there's no atrium, there's no parking. Yeah, and all this, if assuming it turns around, then Suntec will be the bet. Although we don't have officially any coverage on it.
Yeah. So okay, you mentioned the REITs. So these are the sectors, potential beneficiaries. Any other potential sectors that will benefit from inflation, or you want to go into like perhaps there are certain sectors to avoid because of inflationary issues?
Yeah, if we go along the theme of utilities being the worst hit, then it will be the Sembcorp Industries, which will be a bit more worried. I mean, although we don't have a Celcorp, ours is a whole core, I think. But those will be the sectors where we will be a bit more because utilities are supposed to be stable, supposed to earn that no government regulated return. Yeah, but at the same time, right now with all the pressure on raw materials, so I mean, like you mentioned, so that will be the one area that we will be a bit worried. Construction is also another sector, although it's a bit small, but they are facing many challenges. I think construction, not enough workers, worried. Even if you have jobs, you worried your contractor is either he doesn't turn up for work or he ran away. So
Okay.
construction is another sector. I mean, I don't want to go too much into it, but it is another problematic area right now. In general, I mean, for not every contractor, but I guess most. Yeah. So these are the two sectors which are facing a lot more issues. Yeah.
Yeah.
But in general, a lot of the sectors in Singapore are doing well. Especially if you have this reopening, of course, F&B, retail, but if you have this reopening team, kind of it changes 360 the whole environment for them.
Yeah. How about the tech sector or the contract manufacturers? And with the Temasek, right? They are injecting some funds into promoting some of these tech sectors in Singapore. Do you see some opportunities in this segment, or will it create over effect into certain stocks?
The tech sector, in general, electronics, I guess, is doing very well in Singapore in general. It never had it better because it's right now demand is more than supply. It's not about getting orders; it's about fulfilling them, and that's because the whole pandemic has caused the shift. I mean, the large shift, as we all can expect, the large shift from services. The income spend has shifted to goods and electronics. So most of them, almost every manufacturer will benefit. But the problem is just the whole supply chain is an issue. So a lot of them cannot meet the. So if most of them, like for instance, if you have sorry, let me just dial back a bit. So in the third quarter, a lot of them face issue in Malaysia because of the whole COVID. In Vietnam, everyone had disruption, and then the semiconductor is also causing a lot of them to hold back. They cannot fulfill all the orders because there's just lack of it. But electronics in general are doing well. So right now the challenge is the electricity curbs for those who have plants in China. It depends which province, but in general, I did check with one manufacturer in China. So it depends on how large your company is. So some might have out of 7 days, 1 day shut down, 1 day to 4 days. So of course, if you're the tiny company, you're doing textile, something not important, I'm sorry for you, man. You're like half your week is shut down. So I'm not sure how they're going to operate. But actually, there's a bit of a throwback right now. So a lot of the low value added goods, you might find a bit of shortage, which might hit the construction industry because firstly, the electricity is shut. So a lot of these small, those who manufacture small items might get hit. Then secondly, with all the shipment costs, one container now you bring into Singapore maybe 14,000, which is probably more expensive than the goods inside. So now I'm going to ship here. So there's a bit of an issue which we might face in the later part of this year. A lot of aluminium parts because China steel production is all down. Everything is down because of electricity cut. Yeah. So we might face a lot more component shortage, which may not be on electronics, but across your hardware shop, or maybe your hardware shop might have a lot of things that he may not have because a lot of these come from China. Those small low value items might get hit in the coming months.
Are there any specific listed counters that you want to bring up?
Okay, I just give you some flavor. Some of them I'll just give you a sense because not everything's under our coverage, so we cannot kind of say too much. But just to give you an idea, like when the curbs happen, there's one company that is based here, OM Holdings, but they're actually listed in Malaysia and Australia. So they do ferrosilicon. So because they are the cheapest producer because they use hydro out of Sabah Sarawak, and when the electricity curbs happen, their biggest competitor, China, couldn't produce anymore. So and then ferrosilicon price jumped from 1,600 to 4,000. So the beneficiary, another company could be, I think one small company could be like Far East. They do like air conditioning, which kind of benefits because right now a lot of it is needed for medical products. So these are little companies where are enjoying some of these benefits. Yeah. But I mean, some of them we don't cover, so we cannot like dwell too much on it. But in general, there are pockets. There are a lot of opportunities, a lot of stocks that are doing well in Singapore.
So
just that
I
you could go in and check with them.
Yeah, I come back to where you started. You talk about Del Monte, the company that do the food, selling food, all this. So you come back to like whether it's the F&B sector or the commodities firms in Singapore, whereby there's a few listed ones. So what is the impact of all this inflation on this cluster of business, the F&B, the commodities? Yeah, can we have your view?
Yeah, sure. Right now they don't really feel it. Right now, like I said, like if you use the market, they can raise price, number one. And then if you look at let's say airlines, just take a simple one, maybe for everyone to understand, to appreciate. Like all prices is not going to worry them. The more important, you feel the plane, right? So right now, material, the higher commodity price doesn't really affect them right now. More is to get the operating leverage. When you feel the planes, you get the operating leverage. So that is not an issue for the stocks for at least the next 1 to 2 quarters. I think you only feel it maybe in the second half, where if the economy slows, then you are not able to pass on the price increase. So right now, if you're an electronics guy, whatever price you put in, they don't mind because they want to get the supply. So right now it's fine. Everyone is smiling, everyone is happy. But I think you will only feel it, the margin squeeze in the second half. So you can say right now is a so-called good inflation. I mean, like a better word, where you can pass it on because your consumer just had wages are rising, so everyone is fine. So you're having this sweet spot right now. When you go across the board, most companies are not complaining about margins right now. In general, I mean, yeah, I think you only feel it late next year, I think. Because when you reopen, when you reopen a F&B, I don't think they're going to complain the price of crabs is too high, right? It's about whether they can get in the customers in. So I think later on they'll complain, the price of crabs is too high, but right now, no.
Yeah. A related topic. I remember the older people, maybe including myself, we always have this idea that gold is a hedge against inflation, right? That's just like passed down from the parents or the parents' parents. Oh, when there's inflation, buy gold, right? On the other hand, nowadays, there's also a lot of people, especially the younger ones, are looking into the cryptocurrencies. And someone actually showed a chart that, hey, nowadays, when the money supply increases, the M2 increases. So someone was showing a chart of the correlation between the Bitcoin prices versus the M2 supply. So the gold price might not be a good reflection of inflation anymore. So perhaps we'd like to have your views on how do you see this gold and the cryptocurrencies?
Yeah, actually for us, gold in particular, when we look at the many charts that we look at now, because we have the database, gold price has recently been very well correlated with the amount of negative debt out there. So when the amount of negative debt goes up, the European bonds are all negative, right? So even corporates also negative. You can see that gold price tend to move along. And I think intuitively, I guess you can see that why would I want to park and earn negative returns on myself, park my money in gold? So likewise, you are beginning to see this amount of global negative debt start to taper down. So that's why gold price. Our view of gold is that it will only move, we think, there are probably like 5,000 views out there, but the we think is that if you get a rout in bonds, because if people get to worry about bonds, and if there's a major sell-off in bonds, then people need to exit out of bonds. So the flow of money might go into gold. So gold can be a good hedge if you have a lot of bonds, because if bond prices start to capitulate, I'm not saying it will. If it does, it's going to be a problem for all of us. It's like 22 trillion US debt out there, right? It's going to be the biggest negative wealth impact for all of us. But if that happens, gold would be the big hedge for everyone, because the investors will then need to shift the money to. Nobody want to hold gold because the prices are dropping. So that will be one area that will benefit. Until then, our own view, for what it's worth, is that gold will be probably at best move sideways, because the interest rates, if they slowly creep up a little bit, then I myself earn something. I myself put my money in an instrument that earns a yield. So if it continues to just creep a little bit, we think gold will be sideways. Unless you get this big drop and people start to panic about bonds, of course the liquidity will flow into gold. That's our scenario. For Bitcoins, I have no idea. It's like it can sink 10%. I guess the biggest value for gold is probably for gray metals, I guess, to cut the story short. It's probably for another way to store your wealth in less publicly disclosed areas, I guess.
Yeah.
That's the value, I think.
I know you covered very wide, right? And we also know that beyond the SGX listed stocks. A lot of Singaporeans are already looking into the regional stocks or global stocks, especially the US. So when it comes to the US market itself, do you have any views on the market or any specific stocks that you would like to point out to the audience to take a look?
For us, not really. I think we don't we do have a US research team, but they are mainly into US tech stocks. They're mainly into the FANGs. If I would just put on their hat, I mean their recommendation, the favorite for them would be Amazon actually. Because of course the first thing is the cloud. So cloud is doing well, so they are still the winner. But one thing that might have changed is is advertising. Because right now with all the rules, with Apple restricting the amount of data that can be released for advertisers and so forth, we got all the privacy, right? So you can actually choose what data can go to all these advertisers. The swing in advertising might actually go to Amazon. So Amazon might get, apart from their multiple streams of income that they get from elsewhere, they might get this additional stream as an advertising platform right now, because they are the only ones that has access to this proprietary data on clients. Because right now, if the phones restrict the way is being scripted now, I think maybe Apple may not be releasing all this data to Facebook, to Google. So that's where they're coming out. So from their perspective, Amazon seems to be a better bet amongst the FANG stocks. Yeah, because we focus mainly on tech for our US team.
Okay, good. Wow, you recommend the different sectors from Singapore that will possibly be impacted by inflation. Some on the US, specifically this Amazon. But I believe the other aspect on the macro front for investors, right? Beyond all these things about inflation, deflation, or stagflation, increasing usage of this term about stagflation. So, are there major things that you feel that investors should watch out for? Like I remember 1 month ago, during the previous session, there's a lot of discussion about Evergrande. The China property stock, is it going to be the Lehman moment for China itself, right? Then a few weeks ago, we are talking about the debt ceiling in US. That's something to watch out for. So do you have some advice for the audience on any of the major items they should look out for?
Yeah, I think there are always a lot of shadows there to worry about. I mean, whether these shadows we really got something to worry about. I guess for me, from a very near-term perspective, I think this is probably the known risk. Is mainly more on the pandemic, the virus itself. I think on the back of our mind, in terms of near-term visibility, we always just worry that there's a new variant. I mean, touch wood. Yeah, then they're all bets off. Then whatever strategy you come up, you just forget it because the vaccines don't work anymore. So that for us is the biggest risk that we worry about for near-term. Then the others will be bond prices, the coming election, but those are US election. Yeah. So those are the more worrying things, and geopolitics. But if you talk about near-term risk that we monitor more constantly, is mainly just the trajectory of the virus. So far so good. I mean, if that happens, I mean, the worst case, then yeah, then we might get the same March, April kind of gap down in prices. Yeah, that is the biggest worry for us. I mean, right now, amongst the many shadows that you can see out there.
Yeah. So with you mentioning about the possibility of a Sing dollar strengthening, especially with MAS tightening their policy, certainly hope the year end, when more of the people can finally travel abroad, they can have a good shopping trip. So I see Sri has come out, and he's probably trying to tell us that I need to hand the time over to him. Okay.
Thank you so much, Session, and thank you, Paul Chu, for your wonderful views. We have all taken notes today, 100%. So have I. Well, since this is a fireside chat and we have a ton of questions from the audience, Paul, I'm going to fire away, and we try our very best to answer as many as we can. All right. Okay, the first one is from Fong. He's asking, are you still of the opinion that inflation is transient with MAS tweaking the currency pegging today? Are they just preparing for the storm or typhoon that is to come?
Yeah, I don't think if they are preparing, if they're really preparing, then they'll gap up the whole band of the MES. I think it's more that it's because it's already out there. They made a forecast on their core CPI, and the latest numbers already hitting their upper band. So it's something that, and whatever all the growth forecast that they mentioned is really kind of like exceeding their forecast. So as a result, to be consistent, they had to move the band, and they're just raising it slightly. So it's not like they're increasing, it's just they're just raising the slope a little bit. So that's how they message it. Again, it's a bit kind of it's not the most easy to understand language. So what is raised slightly, but that's the language they like to use. So so for me, it's just a slight improvement. I wouldn't say that they are panicking about zero, but I just think conditions are much better, because this zero appreciation in the Sing dollar has been around since April of 20. That's when the pandemic hit. So it's only fair that they start raising the rates and tightening a little bit. Yeah. I hope that answers that. I don't think it's more like they're freaking out. Otherwise, they'll gap it up. But yeah, they'll gap up the band. They'll gap up the whole exchange rate if they want to tighten even further.
All right. Well, this question could be with a possible holiday in the future in mind. Wilson is asking, many countries are printing money, like the US being a prime example, and Singapore is digging into our monetary reserve. How will this currency exchange affect us when being compared to the US dollar, renminbi, pound, and euro in the future?
Well, I think if you look at our foreign reserves, I think you'll be like ultra bullish on the Sing dollar. I think since the pandemic hit, I don't have the numbers in front of me. Let's say 2018 and 2019, our foreign reserves hardly move. It's like a snooze fest. It's like a flat line. But since the pandemic hit almost to the dot, March onwards, we jumped 80 billion US incremental last year. I think this year we're hitting about 50 billion. So our foreign reserves are like all-time high. So it kind of just re-emphasize that we have that safe haven status. So I wouldn't be if the question is about Sing dollar, I wouldn't be too worried about Sing dollar. I think if you just look at our reserves, you'll be like clapping hands, because it's like all-time high during the worst of the crisis. So a lot of liquidity actually came into our country. I mean, when the pandemic hit. So yeah. So I hope that answers. I'm not sure if that helps for the viewer.
All right, Paul. Not just this attendee, several analysts that I've spoken with have also said that cash might be a solution for now until things become clearer. So, do you think cash is king now until a correction happens and you can jump in?
Yeah, cash is always king. But because if you have cash, then you take the stance that you want to be an opportunist buyer. So you just look at whatever hasn't moved. But the problem is a lot of investors don't. I mean, if you want to keep cash, did anyone buy DBS when it was 17? You probably didn't. Most people would be like, oh, the whole world's crashing, I wouldn't buy. So the problem with keeping cash is that whether do you have the discipline to go in when DBS was 17 or when it was 16 during the whole oil crisis situation. I think it was in 2016, if I'm not mistaken. Yeah. So cash is always very valuable, but you must have, I wouldn't use the word guts. I mean, you must have the conviction, I guess the better word, to use this cash and just go to whatever has been the worst performer. Maybe rubber has been like the worst performer. Some of those rubber stocks, the share prices probably didn't move for the last, I don't know, 5 years. So whether you want to have the conviction to go into this, but that's the worry. A lot of people want to keep cash, but when it's time to act, they don't do anything about it. But anyway.
That's always a fear, right? Is it the right time to go in now?
Yeah. So probably, that's why, if you're like me, lazy investor, don't think so much, right? So you just put your savings every month, just put a little bit. So you're not technically timing it. You kind of just kind of evening out throughout the cycle. That's why a regular savings, not that we are promoting any of our products, but a regular savings does have its merits, because you want to remove that emotion out of you. Yeah. So again, you just have to ask yourself, I mean, when the market was so down, do you actually go in? Yeah. That's probably the test for anyone.
Well, I'll give you an example, personal example of that towards the end of the webinar. Our next question is on property. All right, so property prices are skyrocketing now, and it has outpaced income growth based on this attendees' view. So, is there going to be a major impact to property in 2 to 3 years' time? What are your thoughts?
Yeah, if you look at the property prices, look like they've run a lot the last 12 months, but when you compare to 2013, it's only up, I think, 7%. So if you take a longer term perspective, property prices actually were only up 1% per year compared to your wages, which 2013. I'm not saying whether you were in Phillip or not, but in general, the wage rate would have been much higher than that 1% per annum. So what I'm trying to say is that property prices on the past 8 years virtually has not moved. I mean, it moved like only recently. So if you take that into perspective, property has actually, wages have technically outpaced property prices. And when as amazing as it is, and if you look at the amount of people we did the study too, because we came up with a magazine. If you look at the amount of people who are household incomes 10,000, which earners 10,000 and more, or those household incomes 18,000 or more, because if you want to use them to earn a 1 million loan, I mean, roughly, it has also jumped up tremendous. I can't remember the exact number. That pool of people has actually surged the last 5 years to 10 years. So I don't think it's purely speculation. Maybe other countries perhaps, but it's not purely speculation from the Singapore context. I mean, in my own point of view, looking at the numbers. Yeah.
All right. So next question is a double-barrel question. CDL was $14 like a few years ago, before several crises. What's your 1-year target, and like what do you think the growth area for CDL will be apart from catching up with the rest?
Yeah, our target is, I think, $9 plus. I just slipped my mind. I don't really cover the stock market analyst, but it's about 9 plus. Just do bear in mind, I mean, property stocks, for what it's worth, you're playing the cycle. Like I said, it was $14 and then now it's $6. So you know how volatile the cycle is. So property historically has always, you're just playing a cycle for property. It's not something that you're going to hold like a bank stocks in general. If you look at it, because no property plays on a cycle, property stocks, you only want to buy a property stock if they get enough recurrent income and pay you a nice yield, then you don't mind holding it. But most of them will the earnings will swing, and my goodness, never use PE for property stock, right? It should be at best the PE for property stock should be one time, because after one project, there's none. So you just play the cycle. It's not meant to be because you will get a downturn in property. So just be mindful of them. Yeah, for property names.
So I mean, you've addressed it during the webinar. Like, are there any potential, maybe not black swans, but are there any threats in the market that we should be aware of as a trader in Singapore or in the region?
Apart from what I mentioned earlier, the rest are very known threats. I mean, geopolitics and but there are so many threats out there. It's just about the probability of it occurring. So the higher probability is probably on the delta part. That's why we are a bit more mindful. Although we are not like doctors, but we all intuitively know that so long as the number of cases are so high, there's always that risk of a mutation. So the risk is everywhere, but you have to assign, right, what is higher probability, what is low probability, like a meteor hitting us, that's low probability, hopefully. So for us, the higher probability is the virus mutation. That's what we worry most about. Yeah. Yeah, you can't be worrying about everything, and you probably will never go into the market. Obviously. Yeah.
All right. So this is another question from Fong again. Fong is asking, Are real wages rising? I mean, you mentioned that wages have actually surged quite a bit over in the last few years compared to property, but are real wages rising?
No, no. In the US, if you look at the data, it's not. I think the don't if you like inflation rates in the US about 4-5%. I think the latest number. If not, wages there is growing about 3% plus. So it is not. So there is a catch up, and you can see everywhere. If you look at the vacancy rates compared to the number of the employment is also at all-time highs. Likewise, in Singapore, the number of vacancies out in the Singapore job market is all-time high. The stats we always like to quote, there's about 163 jobs out there for every 100 people unemployed in Singapore. Of course, I mean, it varies, right, depending the managerial level, but it's also all-time high. So right now, the global situation is there are more jobs than the people looking. There's a lot of vacancies out there, and that is the squeeze that a lot of companies here are facing. They cannot open because they don't have enough. Mainly more acute in the F&B when we spoke to one of them recently. Yeah.
Hmm. All right. So as we know, with the regulatory crackdown in Hong Kong and China recently, what are your views now on Chinese equities, especially Alibaba, Tencent, and Ping An?
Okay, I give you my 5 cents worth of view. I don't really look at it,
Sure.
but yeah, but when I speak to some fund managers, those who focus on, they were buying. The rationale, rightly or wrongly, is just that these are core technology names. These are the names which the government cannot afford to fail, because you are fighting on this tech. If you believe in the war of technology, right? So from this fund manager's point of view, I mean, just among friends, to them, these technology names cannot fail. They just have to go through this. Of course, they got their own conspiracy theories about why, but you just have to go through this, and it's an opportunity to buy from their perspective, because the technology, the database that all these companies have, even though you have all these fines and so on, it doesn't really unseat their competitive edge. Again, that is their view. I don't have anything more. I'm just like a parrot to what you're just saying. Yeah, that's my answer.
Well, personally, on personal level, I think there could be some truth in what you say. So that's my 2 cents to your 5 cents. All right, so we have a few more questions. Let's see. All right, do you think the inflation risk will negatively affect the Asia high yield bond prices? Would you be able to just quickly share what's the relationship between the two and how it could impact?
Yeah, my own sense, I never did the data, but I guess Asian high yield will be more sensitive towards credit risk. If the economy is performing well, the default risk, I think that would be the bigger concern. And like you see, Evergrande now, I don't think people are worried about rising interest rate in China. It's more about whether the thing is going to default or not. So I think that may have a bigger influence on Asian high yield bonds than higher interest rate. For me, the core is that if the rates are just rising gradually, that's fine. Everyone can adjust. It cannot gap up because there's so much leverage in the system. Bond yields cannot gap up, then it's going to be a shock. And then we're going to have this. As you all can remember, the 2013 Euro debt crisis whatsoever. So we cannot have a bond yield gapping up, especially in the US or whatsoever. Then we may have this kind of Euro crisis, reoccurring. So most important, every day you read newspaper, it's just up slowly. That's fine. You can just rest well. You just do not want to have people freaking out and some big bond riot bond route out there. Yeah. So I that's my own sense. I don't really look at credit, but if you just look at Evergrande, you can see the bigger concerns than interest rate. Yeah.
All right, Paul, maybe we have 3 more final questions before we wrap up for the day. And Chun has been having a nice break while I was firing away with the questions. Chun, maybe I have a question for you first. As CEO of Phillip Futures, of course, you manage a company that has derivatives products. What are the trends that you have noticed, recent trends, and what sectors actually excite you and why?
Well, actually, I wouldn't say the sectors, but I think recently commodities are really moving, right? Right at the beginning, we talk about coffee prices, and coffee prices has been going up, and it's probably at the highest in the past, don't know how many years. It's probably at the highest point, at least for the past 5 years. Okay. Even the other one is palm oil. Palm oil prices has also been going up quite a lot. So one reflection that we can see, whereby is it getting very volatile, is also when we see the exchanges raising the margin, because they raise margin when it's very volatile, or it could be, of course, it's a reflection of the speculative interest as well. When the prices move a lot, so they'll raise the margin as a means to control the participation. So it's a part and parcel of risk management function. So certainly over the last few months itself, some of the commodities, and then lately some of the metals has been moving because of the, like Paul mentioned, electricity issue, the power issue in China. So there's an impact on the metal prices as well. So I think lately is the key move are all these commodities. The other part moved a fair bit. Early last month was the China index. We call it the A50 in China. They call it the CSI 300. Of course, all this got to do with the China Evergrande issue. These are the ones that people are concerned. So certainly it's reflected inside the index, and you can see the index was actually quite volatile early September itself. Yep. So I think these are the commodities has been moving. I think recently, of course, crude oil we can see, but there's also like natural gas prices. Those are the so-called the contracts or the products that have been very volatile and reaching new high, at least over the last few years. Yeah.
All right, so a follow-up question from what Chechen just said, and we just received this question. So where do commodities counters like Wilmar stand? Chechen?
The specific counter itself, I don't think I'm a good analyst on that, but certainly Wilmar should have owned a lot of plantation in Malaysia and probably in Indonesia itself. And with all the crude palm oil prices at such a high level, I believe that should have they will benefit from the prices. But on the other hand, they are also in the so-called the production side of things. They are also involved in other parts of the value supply chain. So I can't forecast on that portion. I only can see that because they do a lot of palm oil plantation, they own a lot of palm oil plantation, so they should benefit quite a fair bit on the increase in prices. But in this aspect, I'm not sure whether Paul has some views on this specific counter.
Sorry, Paul, you're muted right now.
Oh, my apologies. Is it better? Can you hear me? Oh, okay.
Yeah,
Sorry for that. I don't. Yeah. Anyway, when palm oil hit 5,000 all-time high, prices like Wilmar all gapped up because palm oil stocks in general were under-owned, and palm oil right now is seen like oil proxy, rightly or wrongly. I mean, you can have your own view because there's a biodiesel element to it. So that's why we think there's and you have to kind of believe in the Wilmar's ability to get incremental margins when you have such a nice directional move in the palm oil price. So I think Wilmar should do well in this kind of environment where palm oil prices kind of surge up so high. But we don't really cover Wilmar. But if you want to treat it as a proxy to palm oil, I think Wilmar will obviously be the big beneficiary, because they a large, if you do the sums, not whether is it 1/3 or more of all the palm oil goes through them, either through processing or through selling or through trading through them. So they have quite a large market share of all palm oil in the world.
All right. So my final question: would you like to talk about ESG, or would you like to talk about REITs, Paul?
I think I'd rather talk about REITs because ESG, yeah,
Okay,
yeah,
REITs then. All right. This question, okay. Now work from home, right? Is I mean, we all know, right? In the last 2 years, most of us have been working from home, and then offices potentially might be thinking about downsizing and doing hot desking, or there'll be social working spaces where it'll become a whole lot more normal. And let's see what else. Um, yeah, so more businesses are going online as opposed to having a shop front. And as we know, like we have people who are around, I mean, closing their shops permanently from a mall. So what's going to happen to REITs in the future? Is there a concern, or will properties will always be there? They will adapt, evolve, and survive.
Okay, I'll just give you very general views. Firstly, for retail, from a Singapore context, the suburban malls will always be there because these are virtually monopolies, right? I mean, you pick any mall, they have a MRT underneath, and within a 2 to 3 kilometer radius, there's nowhere else to go for us, right? Because there's no other malls. So malls in Singapore are very unique. It's not like Malaysia, you got one mall on your left, and when the business is good, there'll be another mall on your right. Yeah, so that's the difference. So malls in Singapore are very unique.
Tampines, Paul, Tampines.
Oh, Tampines. Okay. Yeah. So when you go to one mall, there's nowhere else to go because you're stuck only on one. Okay. But anyway, uh, that is industrial will be a bit more cyclical. Because we are not really such a strong in manufacturing base as in the past. For office, it's probably we're more negative on office amongst the various sectors. Namely, number one, I think you've seen the banks starting to use this opportunity to downsize. I think DBS is cutting. I'm not sure 80,000 or 100,000 square feet. I can't remember the numbers, but they are already downsizing. And then a lot of the tenants now are really undecided. So they know that hybrid is coming in. There's an eventuality. So a lot of leases now are kind of very short term, and because they're not sure of themselves. You ask the tenants because they're more into now trying to save distance the whole office than rather worry about the tenancy. So office, we are a bit more hesitant on it. We're a bit more negative. Because net we think the absorption rate might be weaker than expected. Yeah, although you don't see it this year because there's no supply, right? But we think we are most negative amongst all for office. Yeah, I hope that answers it. I'm not very sure if I really answer your question.
Yeah, I mean, that does more or less answer it. Well, so overall, you see that there could be a future. There's not so much of a concern there.
You think on the Singapore market, right?
On the malls front.
For malls, malls is a unique the special one you can call it. Yeah, because they're monopolies, right? So that's fine. Hospitality we like the most because if you're going to play the recovery, and like we said, some of them are trading below book. So you don't need to have such an aggressive target. You can get like a 15-20% lift to just go to the of course there's also like data centers, but there's a bit of nuance here for the capital because there's some big listing coming up. So there's kind of that might cause some de-rating for that space. But also do bear in mind that if you have a rising interest rate environment, just have to be a bit more careful, and better look for where there's growth. Yeah, you might have to tilt a bit more to growth and be a bit more selective in your choice of REITs. Yeah, because if you got this slow and up and coming kind of headwind, headwind in front of you, tailwind. You got this type of issue with rising interest rates, then there might be a pressure. But do note that REITs usually don't face it so much because they usually cap their interest rates probably 1 year, 2 years, maybe 50% of their interest exposure is fixed. So you don't feel it the next 1 to 2 years, but maybe on then in the upcoming third year, if rates continue to move. That's mine.
All right, there you have it. We heard from Paul Chew and Terry Churchin. Thank you so much for your views for tonight. And if you had enjoyed Paul's views, please let us know if you want us to call him back for another session in the future. All right. Once again,
and if you don't enjoy, also please don't let him know.
Paul, thanks a lot for
Thanks.
joining us tonight.
Thank
I will certainly take a closer look at the counters that you mentioned.
yeah, it's a good opportunity.
Yeah.
all right. Thank you so much. And members of the audience, thanks for joining us. If you have more questions, please send them into the question box at the end of the webinar. All right, there'll be a survey form. You can type in the questions there, and we'll collate them for Paul to give his 2 cents, and then we'll send them over to you in our follow-up email. All right, thank you for being a wonderful audience. Look out for our next Fireside Chat and webinar. Till then, take care. Bye-bye.
Okay.
Thank you, everybody. Thanks. See you, Chichen. Thank you. Thanks.